The silver market is breaking, and in this video, we are going to show you exactly why, using real data, real numbers, and a level of clarity that most financial channels will never give you. So in this video, we're going to separate what's real from what's just hype. By the end, you'll walk away feeling calmer, clearer, and far more confident about what you are actually buying, and more importantly, why you're buying it. Today is Thursday, March 12th, 2026, New York time. Drop a comment below and let me know the exact day and date you're watching this from. I love seeing where and when you're tuning in. And real quick, if you appreciate content that's built from scratch, thoughtfully researched, and never copied, support the channel by subscribing and commenting RJohnAG below. It helps this channel grow more than you think, and I truly appreciate it. Now here is the hook that I need you to sit with for a moment before we go any further. Imagine walking into a bank vault that holds exactly one gold bar. And then imagine that the bank has handed out 356 receipts to 356 different people. Each one of those receipts saying the exact same thing, that the gold bar belongs to them. Each receipt looks official. Each receipt has a number on it. Each receipt has been bought, sold, and traded on the open market, like it represents something real. Now imagine the moment one of those 356 people walks through the door and asks to take their gold bar home. What happens to the other 355? That is not a hypothetical story about a bank. That is the silver market in the year 2026. That is the COMEX, and that is exactly where we are starting today. The silver market is one of the most important and most misunderstood commodity markets in the entire world. Most people who talk about silver on the internet are either trying to sell you something or trying to scare you into buying something. What we are doing here is different. We are looking at the actual mechanics of how this market works, why it is under stress, and what that stress actually means for real people who are holding real physical silver or paper silver products. Because here is the truth that most channels skip over entirely. There is a massive and growing difference between owning silver and owning a promise that silver exists somewhere with your name on it. That difference has never been more important to understand than it is right now. Let us start at the very foundation. The COMEX, which stands for the Commodity Exchange, is the primary futures exchange in the United States where silver contracts are bought and sold. When a trader or an institution buys a silver futures contract on the COMEX, they are essentially purchasing an agreement to receive a specific quantity of silver at a specific future date. That agreement is backed, in theory, by physical silver stored in what are called registered vaults. These are warehouses, certified by the exchange, that hold actual physical bars of silver that can be delivered against contracts when they come due. The system sounds reasonable when you explain it that way. It sounds orderly, it sounds safe, but here is where the numbers start to tell a very different story. As of the most recent data available in early 2026, the total amount of silver sitting in COMEX registered vaults represents a fraction, an alarmingly small fraction of the total open interest in silver futures contracts. The ratio that analysts have calculated is 356 paper contract ounces for every single physical ounce sitting in those registered vaults ready to be delivered. 356 to 1. Let that number settle in your mind for a second. That is not a slight imbalance. That is not a minor inefficiency that a well-functioning market can absorb quietly. That is a structural fragility, so extreme that even a modest increase in the number of traders who decide to take physical delivery instead of rolling their contracts forward could trigger a cascading series of failures that the exchange would struggle to manage. Now you might be asking yourself, has this always been the case? Is this just how futures markets work? And the honest answer is that yes, futures markets have always operated with more paper contracts than physical inventory. That is actually by design. Most participants in a futures market are hedgers and speculators who never intend to take delivery. A wheat farmer sells futures to lock in a price. An airline buys oil futures to protect against rising fuel costs. Neither of them wants to show up at a warehouse with a truck. So a gap between paper and physical has always existed, but the current ratio of 356 to 1 is not a normal gap. Industry analysts and commodity market historians have pointed out that this ratio has expanded dramatically over the past several years, driven by a combination of rising industrial demand for silver, declining mine output, and a surge in speculative positioning that has piled more and more paper claims on top of a physical base that is not growing fast enough to keep pace. What makes this particularly significant right now is the convergence of several other forces that are all pushing in the same direction at the same time. We are not talking about one problem in isolation. We are talking about a cluster of interconnected pressures that are all applying stress to the same point in the system simultaneously. The paper-to-physical ratio is the headline number, the one that captures people's attention for good reason, but it is only the beginning of the story. It is the visible symptom of something much deeper happening beneath the surface of this market. And to understand that deeper story, we need to talk about something that most silver investors have never even heard of, and that is silver lease rates. Because what is happening with silver lease rates right now is, in the opinion of many serious market analysts, the single most revealing data point in this entire situation, and it is signaling something that the spot price has not yet fully reflected. But before we get there, I want you to truly appreciate the weight of what we have already established. 356 paper ounces for every real ounce. That number is not normal, that number is not healthy, and that number is the foundation on which everything else we are about to discuss is built. Lease rates, China's export controls, and the 820 Oz deficit. So let us talk about silver lease rates, because if the 356-to-1 paper-to-physical ratio is the headline that grabs your attention, then what is happening with lease rates right now is the story underneath the headline that should genuinely keep you up at night. Most people who follow silver have never heard of lease rates. They track the spot price, they watch the futures curve, they follow the headlines about industrial demand or central bank policy. But lease rates are something different entirely, and understanding what they are and what they are signaling right now is absolutely critical to understanding the full scope of what is happening in this market in 2026. A silver lease rate is essentially the cost that someone must pay to borrow physical silver from another party. Think of it like an interest rate, but instead of borrowing money, you are borrowing actual metal. The reason someone would want to borrow physical silver rather than simply buy it comes down to a practice called short selling. When a trader or an institution wants to bet that the price of silver is going to fall, one of the ways they can do that is by borrowing physical silver, selling it immediately at the current market price, and then hoping to buy it back later at a lower price so they can return the borrowed metal and pocket the difference. The lease rate is the fee they pay for that borrowed metal while they hold their short position. In a healthy, well-functioning silver market, lease rates are low. They hover near zero or slightly above it. Low lease rates tell you that physical silver is abundant, that it is easy to find, that lenders are not under pressure, and that the market is in balance. High lease rates tell you the exact opposite. They tell you that physical silver is becoming scarce, that finding metal to borrow is getting harder and more expensive, and that the underlying physical market is under serious strain. Now here is where the numbers in 2026 become genuinely alarming. Silver lease rates have not just ticked higher, they have not just risen to a level that raises a few eyebrows among analysts who follow this market closely. Silver lease rates have exploded to levels that are 1,460% above what would be considered normal functioning levels for this market. 1,460%. That is not a statistical blip. That is not a seasonal distortion. That is a market screaming at the top of its lungs that the physical silver needed to cover short positions, settle contracts, and satisfy commercial delivery demand is becoming extraordinarily difficult and extraordinarily expensive to source. When lease rates spike to this degree, it means that the people who need to borrow physical silver are competing aggressively for a pool of available metal that is simply not large enough to meet the demand being placed on it. And the more they compete, the higher the rate goes, and the higher the rate goes, the more stress it places on every short position, every paper contract, and every institution that has been operating on the assumption that physical metal will always be available when they need it. What makes this lease rate explosion even more significant is the context in which it is occurring. This is not happening in a calm, stable market environment where one variable has moved unexpectedly. This is happening against the backdrop of the paper-to-physical ratio we already discussed, against a futures curve that has inverted in ways that seasoned commodity traders describe as deeply unusual, and against a geopolitical development that has sent shockwaves through global silver supply chains in a way that no financial model fully anticipated. And that development is China. China's decision to implement new export licensing requirements for silver is not, as some commentators have tried to frame it, a routine administrative update to how the country manages its commodity exports. It is a strategic move by the world's largest silver-producing nation to assert greater control over where its silver goes, how much of it leaves the country, and under what conditions international buyers can access it. The practical effect of this policy has been immediate and severe. Physical silver that would previously have flowed from Chinese refineries and warehouses to international markets, including to COMEX vaults and London clearinghouses, is now subject to licensing review and approval. That review process takes time. It creates uncertainty. It reduces the predictability of supply that global markets depend on to function smoothly. And the result has been a dramatic rise in what is called the Shanghai silver premium, the gap between the price of physical silver in China and the spot price quoted on Western exchanges. When that premium rises sharply, it is telling you that buyers inside China are willing to pay significantly more than the official market price to secure physical metal, which means supply inside China is being kept tighter, and the outflow to the rest of the world is being deliberately managed and constrained. Now layer on top of all of this the cumulative supply deficit that has been quietly building in the silver market since 2021. Since that year, global demand for silver has exceeded new mine production every single year without exception. The industries consuming silver, solar panel manufacturing, electric vehicle production, semiconductor fabrication, medical technology, and defense applications have been growing their consumption at a pace that mining output simply cannot match. The cumulative result of those annual shortfalls, stacked one on top of the other from 2021 through early 2026, is approximately 820 million ounces of silver that the world has consumed beyond what has been pulled out of the ground. 820 million ounces. And the current annual deficit, meaning the gap between what the world is consuming right now and what is being mined right now, stands at approximately 245 million ounces per year. That is not a market in temporary imbalance. That is a market with a structural supply problem that has been compounding for years, drawing down the above-ground stockpiles that once acted as a buffer between supply disruptions and actual physical shortages. Those buffers are thinning. The lease rate spike is telling you they are thinning faster than most people realize. And what happens when the buffers run out entirely is the question that nobody in this market wants to be the last one asking. Cash for delivery, bull versus bear, and the critical mineral revolution. So here is where we answer the question that the middle of this video left hanging in the air. What actually happens when the above-ground stockpiles of physical silver thin out to the point where they can no longer absorb the gap between what the world is consuming and what the mines are producing? The answer, it turns out, is not some distant hypothetical event on the horizon. It is something that is already happening right now, in real time, on the very exchange that sits at the center of the global silver market. It is called the cash for delivery phenomenon, and if you have not heard of it, you need to understand it today, because it is one of the most transparent and honest signals that a futures market can send about the true state of its physical inventory. Here is how it works. When a silver futures contract comes due for delivery, the party holding the short position, meaning the party who sold the contract and now owes silver, is obligated to deliver physical metal to the buyer. That is the fundamental promise that makes a futures contract worth anything at all. The entire architecture of trust in a futures market rests on the assumption that when delivery day arrives, the silver will be there. But what happens when the silver is not there in sufficient quantity? What happens when the registered vaults do not hold enough metal to satisfy all the contracts coming due? One of the mechanisms that emerges in that scenario is exactly what we are seeing on the COMEX in 2026. Rather than delivering physical silver, some short sellers are approaching contract holders before the delivery window and offering them a cash premium, meaning extra money on top of the contract value to convince them to accept a financial settlement instead of taking the actual metal. They are essentially paying people to look the other way. They are offering cash in exchange for the right to avoid delivering something they do not have. And while this practice is not technically illegal, and while it has occurred in isolated instances in previous market cycles, the scale and frequency at which it is being reported in early 2026 is a signal that serious analysts cannot and should not dismiss. When a market starts paying people not to demand what they are legally owed, that market is telling you something important about the gap between what it promises and what it can actually deliver. Now let us be completely fair here, because intellectual honesty is what separates real analysis from noise. There is a legitimate bearish case for silver, and it deserves to be stated clearly and respectfully. The bearish argument centers on mean reversion, the well-documented historical tendency of commodity prices to return to their long-run averages after periods of speculative excess. Silver has been here before. It spiked dramatically in 1980. It surged in 2011. Both times, it gave back enormous gains as speculative interest cooled, industrial conditions shifted, and the forces that had driven prices higher ran out of momentum. The bears will tell you that the lease rate spike and the paper-to-physical ratio are real data points, but that they do not necessarily lead to the kind of systemic failure that the most aggressive silver bulls are predicting. They will argue that industrial demand could soften if the global economy slows, that above-ground silver in non-registered forms, silver held in exchange-traded funds, in private vaults, and in industrial stockpiles, could be mobilized to ease a delivery crunch, and that the COMEX has tools and mechanisms available to manage stress without triggering a full collapse. These are not foolish arguments. They are made by serious people who have studied commodity markets for decades, and anyone who tells you that the bearish case does not exist, or that it is not worth considering, is not giving you the full picture. But here is what is genuinely different about this silver cycle compared to every previous one. In 1980 and in 2011, silver was primarily a monetary metal and an industrial commodity. Its demand profile was driven by photography, jewelry, electronics, and speculative investment flows. Today, silver sits at the intersection of the global energy transition, the semiconductor supply chain, and the defense industrial base in a way that it never has before. A single solar panel requires a meaningful quantity of silver. Electric vehicles use silver in their electrical systems and battery management components. Advanced semiconductors depend on silver-based materials in their fabrication, and the governments of the United States, the European Union, the United Kingdom, Canada, and Australia have all now formally classified silver as a critical mineral, meaning it has been designated as a material whose supply security is considered a matter of national strategic interest. That classification is not ceremonial. It unlocks government procurement programs, supply chain security mandates, and industrial policy frameworks specifically designed to ensure that these nations maintain access to silver regardless of what happens in open market trading. That is a structural demand driver that did not exist in previous silver cycles, and it fundamentally changes the calculus of what a mean reversion scenario actually looks like when the entity competing against speculative sellers for physical silver is not just an investor, it is a government. This is the landscape you are navigating when you make decisions about silver in 2026. Not a simple bull market, not a simple bear market. A genuinely complex multi-layered situation where the risks on both sides are real, where the data points to serious structural stress that has not yet been fully resolved, and where the distance between paper promises and physical reality has never in modern market history been wider or more consequential. The smartest thing any investor or observer can do in this environment is exactly what you are doing right now, seeking out clear, honest, data-driven analysis instead of headlines designed to either panic you or comfort you. Knowledge is not just power in a market like this. Knowledge is protection, and the more clearly you understand what is actually happening, the more confidently and calmly you can make decisions that reflect your own financial goals, your own risk tolerance, and your own vision for your future. You are not powerless in this market. You are informed. And being informed is the most valuable position you can hold. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.